everyone. Welcome to this special edition of Dollars and Cents. My name is Emma Jane Appleyard, and our programme will focus on information about the new tax code and its impact on residents living in our area. Providing us with insight to the new tax code is well-respected financial advisor Michael Wayne Feynman. Michael has 30 years' experience in finance with world-class organisations such as the Federal Bank Board, the United Nations, JP Morgan Chase and Smith Barney. For the past 15 years and currently, he has been Senior Vice President Investments at Wells Fargo Advisors, working with individual and organisational investors. You may have seen him before on a number of financial TV shows, and he is the founder of Dollars and Cents.
Thank you, Emma. We will be examining the new tax code with all its changes. But I'm also concerned that people don't recognize the substantial tax impact it will have on residents of high-tax states. So part of this seminar will try to educate residents of New York, New Jersey, Connecticut, Massachusetts, and California, and other areas about the tax burden they may face.
We'll examine the changes tax reform brings to each of them. Then we will discuss things you can start doing related to planning.
Throughout the presentation, please keep in mind that Wells Fargo Advisors is not a tax or legal advisor. However, I can alert you to issues that you should discuss with your own tax or legal advisor.
Okay, Michael, let's start with a basic question. Will these new laws be permanent?
All of the new tax brackets and most of all of the provisions are scheduled to expire on December 31st, 2025. That's 7 years from now. That means in 2026, the old 2017 rates will come back into effect unless Congress passes additional tax legislation in the meantime.
Okay, Michael. Well, what can you tell us about the changes to tax rates and tax brackets?
In general, the new law provides lower tax rates and broader income thresholds. Let's compare 2017 and 2018 ordinary income for single taxpayers. As the chart shows, at the lower levels and at the top, taxpayers get a break. In the mid-range, you could pay a little bit more than before. For married taxpayers filing jointly, it appears that tax rates are mostly lower across the board. Turns out everybody loves a lover, even Congress. If you own stock in a mutual fund for a year or more and you sell it at a profit, you have what is called a long-term capital gain. This chart compares the 2017 and 2018 long-term capital gains brackets for single filers. In 2018, capital gains under $38,600 pay no tax. Under $425,800, you pay 15%. And over that amount, you are in the 20% bracket. These are the 2017 and 2018 long-term capital gain income thresholds for married taxpayers filing jointly. In 2018, capital gains under $77,200 pay no tax. Under $479,000 pay 15% tax, and over $479,000, you're in the 20% bracket.
Now, as you can see, we will have a lot of facts, figures and illustrations. I can't imagine you will be able to remember all of the material that we present. So to help you, we would like to give you this brochure, the 2018 Tax Planning Tables, which contains much of the material we cover. If you would like one, please send your name and address to the email address below. It's free with no obligation. Now, Michael, we've covered the tax brackets and rates, and so far, I don't think there's anything that's really terrible. But what is it that's got you so worried?
The biggest problem I see is the loss of deductions and exemptions. This is where people will feel the most pain. First, the good news. The standard deduction has been nearly doubled to $24,000, and that's married filing jointly, and $12,000 for single filers. For those previously who couldn't itemize, this increase should be a really welcome benefit. Now that sounds terrific, but the new tax laws wipes out the majority of previously allowed deductions, which will really hurt many homeowners in the New York area. New Jersey, Connecticut, and Massachusetts, and even California. This is because taxpayers who could itemize in the past will find themselves limited to the new standard deduction. Many will find it to be considerably less than what they could deduct previously. And that means homeowners could be paying a much higher tax bill.
Well, which deductions are affected?
Congress has dramatically reduced reductions for SALT, which is an acronym for state and local taxes, SALT, state and local taxes. These deductions are now capped at $10,000 regardless of how much you actually paid in state and local property taxes, school and income taxes. Property taxes paid in carrying on a trade or a business, however, are not subject to the 10% rule. Basically, the new tax favors businesses over individuals.
Well, why do you think that Congress did that?
I suspect congressmen need to please big business donors to raise money to get reelected. But that's just my theory. The reason that President Trump put forward was that the middle class would benefit from lower taxes, and by reducing taxes on businesses, they would hire more workers and build new facilities. I'm a student of finance, and I can tell you this strategy has never worked. Common sense, no businessman will ever spend money to expand a plant or hire a single new worker unless the backlog of orders just couldn't be filled any other way.
So what do businesses do with all of this money?
Most of the big companies bought back their own shares. With less shares outstanding, companies pay less in dividends. And it also tends to push the price of their stock up. You may have noticed that the stock market reached new highs, record highs as a matter of fact, since the new tax laws went into effect.
Now, couldn't Congress anticipate that this is going to happen?
Yeah, they should have known, because Presidents Kennedy and Reagan both tried similar programs. And according to the Office of Tax Analysis of the U.S. Treasury, both failed miserably because lower tax revenues resulted in massive deficits. Our deficit last year was $20.2 trillion, bigger than the $2.8 trillion that it was under Reagan. Now, to be fair, that was 1989, 29 years ago. However, the debt was equal to just half of what the GDP was then. Now, our GDP is $19.4 trillion at the end of last year, and outstanding debt was $2.2 trillion. That means if we gave away the entire U.S. production, we would still owe $1 trillion. Now, Trump budget will add onto that an additional $4.8 trillion to the debt. Economist Joseph Stiglitz, who knows something about this subject since he won the Nobel Prize in economics, says Trump's budget takes a sledgehammer to what remains of the American dream. Senator Bernie Sanders also criticized the proposal. This is a budget which says that if you are a member of the Trump family, you may receive a tax break of $4 billion. But if you are a child of a working class family, you could well lose your health insurance you currently have.
That's terrible. Was Congress aware of this?
Once I also had a lot of faith in Congress, not so much anymore. Their own Congressional Budget Office projected that the GOP's signature tax law would increase the national debt by $1.9 trillion by 2028. Some Republicans argued that tax cuts in the bill would pay for themselves. P.S. It hasn't happened yet. Treasury Secretary Steven Mnuchin went so far as to say that they would ultimately reduce the national debt and deficits. That's a magical concept. Borrow your way out of debt. Returning to our main topic, the Trump $10,000 limit on state and local taxes, deductions rather, will especially impact those in high tax states like New York, New Jersey, Connecticut, Massachusetts, and California. Although taxpayers may still itemize, eliminating the state and local deductions may negate any savings from the lower federal tax rates and brackets. Taxpayers will find it difficult to match the level of deductions formally available, and in turn, they will face higher tax bills. Additionally, the fact that you could deduct state and local taxes meant you were only taxed once on the funds. Now, since you can't deduct them, they'll also contribute to the basis for your federal taxes. In effect, this is double taxation.
Well, what are the changes should people be aware of?
Well, starting with the mortgage interest deduction limit, it's been reduced from 1 million to 750,000. This means interest is only deductible on loans up to 750,000. This reduction applies only to debt incurred on or after December 15th, 2017. Home loan interest, which is different than a mortgage, can now only be deducted if the money is used to buy, build, or improve a qualified residence. All these changes are scheduled to expire after December 31st, 2025. But right now, Congress is trying to make these changes permanent before the November elections.
So far, we've lost state and local deductions and a chunk of mortgage money. Is there anything else?
But wait, there's more. The following deductions have been eliminated entirely. The deduction for tax preparation fees, eliminated. Think about that for a minute. Why would they want to do that? Do they want to prevent you from using a tax professional? Okay. Secondly, unreimbursed employee expenses, eliminated. This really bothers me. If their goal was to help the middle class, then why take away the means for workers to write off job expenses that aren't covered by their employer? Finally, investment expenses, eliminated. This is what you pay when you buy or sell investments.
My head is spinning. Now, would you please give us an example of how this will work in the real world?
Okay, this is a hypothetical example that will help you see the impact that certain deductions, the loss of them in 2018 versus 2017. Assume that a married joint filer's expenditures were the same in both years. So starting with state taxes, $15,000, mortgage interest, $7,000, charitable gifts, $3,000, investment expenses, $5,000. When this taxpayer calculates their taxable income, they would deduct the larger of either the itemized deductions or the standard deduction. In 2017, this taxpayer was much better off because their itemized deductions would total $30,000. Under the new law, state taxes are only deductible up to the limit of $10,000. This includes state and local income taxes, property and school taxes. In addition, investment expenses are no longer deductible. In 2019, this taxpayer would have no choice but to use the standard deduction of $24,000, which would be $6,000 less than they could deduct in 2017, which means they will face additional taxes on $6,000 of income.
Sorry, I sidetracked you in the middle of personal deductions. Were there any more?
The next big change is the elimination of personal and dependent exemptions, which means there were $4,050 per person in 2017. That means that an average family of four would lose $16,200 of deductions.
Are you saying that people who are raising a family are losing their dependent exemptions?
Remember, I'm just the messenger.
Well, if I'm following you correctly, they've doubled the standard deduction for a couple to $24,000 and taken away $16,200 in personal deductions from the average family of four. Now, if I do the math, take away $16,200 in personal deductions from $24,000, the new standard deduction, you're left with $7,800. That's less than the old joint standard deduction of $12,700. It's really hard to understand who these changes are designed to help.
For some families, losing the dependent exemptions may be offset a little by the increase in the child tax credit from $1,000 to $2,000 for children under 17. The income level at which the credit begins to phase out has also been increased to $400,000 for married joint filers and $200,000 for single filers, which allows more families to use it.
Well, isn't this going backwards? If you were able to deduct $4,050 for you and each of your dependents, and now you are only able to deduct $2,000 for each child, doesn't this mean even more of your income will be subject to taxation, especially if you no longer have dependent children?
You're right, but I don't make the news, I just report it. Anyway, I think that this is enough incentive to make people have more kids. Okay? But I think you're beginning to see a pattern. However, there's a few rays of sunshine.
Oh, please, enlighten me.
Charitable cash contributions may offset up to 60% of adjusted gross income, up to 50%. That's up from 50%. Cash contributions above this limit will still be carried forward for 5 years. The alternative minimum tax exemption has been increased, potentially helping many more taxpayers avoid AMT. This is a very good thing. Originally, AMT was intended to stop tax avoidance by wealthy moguls. Over time, it grew and encroached on even average taxpayers. This is one change in the new code that will absolutely benefit many in the middle class. Aside from being shot at and missed, nothing is more satisfying than getting a tax refund. Another positive change will allow people to deduct medical expenses that exceed 7.5% of their adjusted gross income. That's down from 10%. However, unlike other changes that we've discussed, this deduction only applies for 2017 and 2018. So if you're planning to have a serious health problem, you better do it right now.
Do the new rules have any effect on tax-sheltered accounts like IRAs?
Good question. Yes, the rule allowing contribution to one type of IRA to be recharacterized or moved into another type of IRA has been modified to exclude Roth IRA conversions. Assets converted to a Roth IRA must stay in a Roth IRA. Normal IRA contributions may still be recharacterized. Now, 529 plans are sponsored and provided by the state for tax-advantaged accounts for educational savings. Previously, they could be used for college expenses. Now, they can be used for elementary and secondary tuition. And religious schools, and up to $10,000 annually for each beneficiary. This appears to be give wealthy parents and grandparents a tax benefit to pay for private school. Now, ABLE accounts are intended to build savings for expenses that are beneficial to disabled beneficiaries: education, housing, transportation, healthcare, and other related issues to the benefits care. Now, between now and the end of 2025, these accounts may accept tax-free rollovers from 529 plans, up to the annual contribution limit for ABLE accounts.
You've mentioned that the new tax program favors businesses. What tax advantages do they get?
Trump's goal is to accelerate business growth. Here are some of the changes to business deductions. First, the tax rate for C corporations has been permanently reduced from 35% to a flat rate of 21%. The corporate AMT has been eliminated. As we discussed, this is a huge benefit and it's permanent. The legislation includes modified rules for many business deductions. I can only touch on a few. Business owners should work closely with their tax advisors to fully understand and plan for these changes. For S corporations, partnerships, and sole proprietorships, a 20% reduction has been added for qualified business income. If you fall into this category, you must consult a qualified business accountant.
Is every business getting this tax break?
No, not all businesses. The 20% reduction is not available for specified service businesses, specifically those that provide services in health, law, accounting, actuarial science, performing arts, consulting, athletics, or investment and brokerage service fields. For some reason, architects and engineers are excluded from specified business services. On the bright side, small business owners with taxable income below $315,000, married filing jointly, or $150,500, single, can take the 20% deduction without regard or the limitations, wages, or specified business services. The 20% deduction is also available to owners of REITs and MLPs. A REIT is an acronym for a real estate investment trust, which is like a mutual fund that only invests in real estate. An MLP is a master limited partnership, which typically invests in transportation infrastructure for natural resources. Both REITs and MLPs don't pay taxes if they distribute almost all of their earnings to their shareholders, who in turn get a larger payout and the 20% deduction. I recommend them in many of my clients' portfolios. Before we move on, I'd like to offer our audience a way to see how the new tax law will affect them. I have a computer program that will give you an approximation of what you will pay under the new tax code. All it needs is a few data points from your 2017 tax return. No Social Security numbers or anything like that. It's free with no obligation. It's a good idea to know what to expect before 2019 rolls around. It may give you some peace of mind. Call or email me if you want me to run an example for you.
Well, that sounds great. And after hearing all the deductions they're taking away, it would be nice to know if I'll have any money left for food. Now, can you tell us about the effects on estate and gift taxes?
Estate laws are very complex, and they can be thoroughly covered. They can't be thoroughly covered in the brief seminar time we have. I can share some high points with you. An estate has to exceed a certain value before it incurs estate taxes. This value has been doubled to $11,180 million per person. As a result, a married couple, even with basic planning, should be able to transfer up to $22,360,000 with no federal tax. Did someone say give away to the rich? It's also important to note a couple of things that haven't changed. The portability election, which permits the unused exclusion of a deceased spouse to be transferred to the surviving spouse, it's still available. The rules providing a step up in the cost basis at death to heirs still apply. Heirs inherit assets with no tax. To quote George Bernard Shaw, the government that robs Peter to pay Paul can always depend on the support of Paul.
Now that we have covered the major points of the new tax law, what kind of planning should people consider in light of these changes?
Perhaps moving to Canada. Just kidding. If people use a new standard deduction rather than itemizing, they may no longer get a tax benefit for their charitable gifts. However, there still may be a tax-efficient alternative available when donating to charity. Donate stock. When you hold stock more than 1 year, it's increased in value. By giving the stock to charity, you may deduct the value of the stock and avoid tax on the gain. Even if you don't itemize the deductions, you'd still avoid paying tax on the gain. Secondly, gift from an IRA. For IRA owners older than 70 and a half, you may gift from your IRA directly to a public charity and treat the gift as a tax-free distribution. It will also go to satisfying your required minimum distribution, or RMD, for that year. Thirdly, contribute to a donor-advised fund. You get the deduction in the year of the donation, but you may disperse your funds to various charities over several years.
Now, I understand how these charitable donations work, but you're still giving away your money. Are there any ways of lowering your taxes?
Yes, and here are three of my best ideas. Increase your contribution to your 401k, IRA, or Roth IRA. If you are eligible, make catch-up contributions. These actions will lower your current taxable income. Secondly, realizing capital gains related to a business, property, or sale. If you're able to structure a sale so you receive payments over more than one tax period, by treating the sale as an installment sale, this could result in lowered overall tax bills. And then finally, realizing capital gains on real estate. The like-kind 1031 exchange lets you swap one property for another in a tax-deferred exchange. This will push the taxation into the future when the second property is sold, or if held to death, the basis would be stepped up and your heirs would receive the property and the tax gain would be eliminated. There are specific requirements you should meet to get the tax deferral. This should not be attempted without the help of a real estate tax attorney. Regarding estate planning, a married couple with basic planning should be able to transfer up to $22,360,000 with no federal estate tax. You should review your estate plan in light of the dramatically increased exclusion. Examine if your existing documents include formula clauses for automatic maximum funding of a credit shelter trust at the first spouse's death. This may now result in the assets being used to fund the trust with little or none being left for the surviving spouse. Now, a word of caution. The new higher exclusions may tempt you to overlook estate tax planning, possibly resulting in missed opportunities. Death and taxes may be inevitable, but they don't have to be related. If you find the new tax laws to be unfair and upsetting now, it'll be even worse when you see your tax bill in April. People in our region have been targeted, but there's something you can do about it. You can vote for change. I want to emphasize that I'm impartial, independent. I'm not a Republican, I'm not a Democrat. I vote for whoever I feel is the best person to fill a post, regardless of party, race, religion, or gender. I'm telling you this because I want you to know I'm unbiased. I once heard the word confiscatory, so I looked it up. It describes an organization that has the right and authority to seize someone's money or personal property, and you can't do a thing about it. The new tax law fits that description. Even worse is the insincerity to pretend that it's a benefit for the middle class. However, you can change the future by voting in November, the November elections, and dragging all your friends to the polls with you. We can reverse this crushing abuse of power. Regardless of your party, if you live in a high tax state, you will be affected, and it's in your own best interest to see the state and local tax deductions restored. Don't vote, and you're digging your own grave. Because now, Congress is talking about lowering Social Security and Medicare payments to make up for the monster deficits they've created with this bill.
We get the message. Okay, now it's time to lower the volume. Now, the next Dollars and Cents program will return to our finance and investments format. Check with this station for date and time. Call or text if you want the tax brochure or the computer tax report. I'm Emma Jane Appleyard. See you next time.
Today is a day like all the days to come, but what you do today can change all your tomorrows. I'm Michael Wayne Feynman. Together we can make tomorrow even better than today.